Bill, we're seeing a bit of a race here up to the top of the hill to declare an end to the bull market in bonds. I wonder if you're vying with Ray Dalio of Bridgewater to put a flag there at the top of the hill to say that we're entering a bear market. What say ye?
Well, my bear market level, and that was 6 months ago, so that isn't really applicable anymore, was up at 265. You know, I looked at the long-term trend since the early 1980s, and interest rates on the 10-year have been falling by 20 to 25 basis points a year since then. You know, is that a technical mumbo-jumbo? Really not, because it's an indication of what an economy needs in terms of lower interest rates in order to keep going. And so I think ultimately, although we're probably at 235 at the moment, you know, that 260, 65 level is the critical level for interest rates going forward. Do we get there in the next few weeks? Probably not. You know, we've had a 30 basis point increase or 20 basis point increase over the last few weeks due to the Bund taper, so to speak. So, but I think we're moving higher.
Kareem, I want you to come over here. For Bloomberg Television, I'm going to show this chart. We'll show it out on radio. Go to Twitter with that as well. Bill, for the first time in ages, I'm showing bond price. Here's par on the Germany 10-year. Down we go. Bill, as you know, looking at your Monroe Trader, we're down about 3% on full faith and credit. Higher yields. Did you know this, Bill? Higher yields, lower bond prices.
It down.
When does it begin to hurt, Mr. Gross?
Well, that's my old teeter-totter, Tom. It's obvious. Interest rates up, prices down, and that's what you've talked about. Bunds up by 30 basis points with a duration of about 9. Yeah, it's about 3 points. When does it begin to hurt? I think it begins to hurt at the margin here in the United States on mortgages. Ultimately, it begins to hurt, and this is an unobserved fact, I guess, by the street, that interest payments as a percentage of expenses, corporate expenses, are significant. Perhaps 30 to 40%. And so it begins to hurt lower yielding corporations, junk bond corporations, when they try to roll over their debt in 2017 late and 2018 early. And so as interest rates rise, generally, and as interest rates and spreads widen, you know, the hurt begins to affect those lower quality corporations as well as individuals that want to buy a home.